So we're not seeing the Delta variant have a significant impact on economic activity. And in fact, we see it peaking and becoming a non-event midway through the third quarter. As you look at where we are in the actual recovery phase, we're already past the opening in North America. Europe is still accelerating. Asia is already on the downside. What the market is doing now is starting to price in the degree of slowdown. We know we're going to have a fiscal contraction, even with the large budget that's being negotiated. We also know we're past peak liquidity levels. The global industrial slowdown that began a couple of months ago will start to show up in headline data in August and beyond. And in the US, it's spilling over into services and employment. The real challenge with getting people back to work going forward is we went to zero cost budgeting. Companies are going to be hesitant to bring those employees back on the payroll. And we can't underestimate the 4 million people that are still out of work as they deal with long haul COVID symptoms. Investment opportunities in the market today, I would lean more internationally and on the small and mid size of international as they are still in the midst of an accelerating recovery and have very dynamic companies as well as attractive valuations. US equities are a little bit more expensive than international equities. And when you go down market cap, you're going to start to see challenges in the US to sustain margins going forward. There's not going to be a specific sector. The market is starting to discount the slowing that's coming over the next 12 months. We're starting to experience multiple compression across the board. The key is to find companies that really didn't benefit from the excess stimulus that occurred over the prior 12 months. Keep in mind, we had $1.9 trillion of transfer payments to fill a $374 billion hole in personal income. That excess $1.5 trillion went into goods consumption as services slowed and also went into risk assets and kind of created that speculative mania that blew off in February and March of this year. When you look at the energy sector, it's on a unique cycle. It came into the pandemic with significant underinvestment for a number of years, and investors have shied away from the space for ESG reasons or the thought that we're going to go green sooner than many anticipate. The reality is that underinvestment and the transition to green renewable energy is going to take several years and takes a lot of fossil fuels to make that transition. So I suspect we're going to see higher oil and natural gas prices sustained at current levels, so they're not excessive, but be very attractive return opportunities for the foreseeable future. Doesn't mean it's going to happen in the back half of this year because energy was so strong in the first half and we're starting to price in slowing economic activity. And so, but I do think you want to hold energy exposure over the next 12 months as they begin to reprice into these permanently higher commodity environment.